Welcome to the Contract Teardown Show from Law Insider, where legal experts tear down contracts from some of the most well-known companies and high-profile executives around the world.
In this episode, Tyler Stone talks tax implications of an international merger. So let's tear it down. Tyler Stone, welcome to the Contract Teardown. How are you today?
I'm doing well. Thank you, Mike.
I am excited to rehab this conversation with you. We have had this conversation before, and you know that it had to happen again because it's about tax law, the most fun subject in the contracting world. I mean, we deserve to have this conversation twice. What we're going to do is dig into the tax implications of a document. It's this document. I will share it with the folks at home. It is an agreement and plan of merger and reorganization as titled. Tyler, before we dig into it, what is this document?
So basically, this is going to be an intercompany merger between different entities in Israel and the United States. The parent company is a U.S. company, and we have two Israeli subsidiaries that are looking to merge.
Great. And there's a bit of a theme to this, which is let's play reindeer games with tax codes. And it's basically, as we'll talk about toward the end, it's this question of, can you use contract to solve other purposes, specifically tax implications? Can we signal intentions with it? And so we're going to go through this thing in some specific sections. As we do, I want you to sort of, key in for us, where are those sections where they're trying to play those reindeer games and whether you think it's working or not. So to do that, we'll start with the recitals. We'll start with Recital B. It is intended that for United States federal income tax purposes, the merger shall qualify as a transaction in Section 351. We're laying out intentions. I mean, it's explicitly saying we're trying to do X relative to the tax code. What do you think of this section coming up so early in the recitals? Do you think it's effective in communicating those expectations?
Yeah, I mean, that's a very good question. So the IRS and the Internal Revenue Code is going to want to see that every transaction was done for some sort of business purpose, or in other words, a non-tax purpose. So to put this in the front is kind of makes you scratch your head to say, well, if it's the second recital, is it really not the purpose of the contract? Nevertheless, the intent is really important. And this is, I've seen thousands of times where we want to try to put the tax code rules up front and lay them out and say, this is what we're doing. This is our intention. And you should probably enter into the contract a section somewhere about the business purpose of the contract. So
right. Like, does having it this early actually call attention to, hey, tax stuff when, to your point, right. You got to show a business purpose. Well, let's go to the description of the transaction. So this is in section 1, and specifically we're going to target 1.1 to 1.3 because I wanted to ask you about timing. There's stuff in here where obviously it describes the merger and who's in existence after the merger, but it also talks about closing and effective times of the merger. Talk to us about these sections and the relationship between the timing of this transaction and the timing of the taxation.
Right. Okay. So very good questions. Going back real quick to Recital B, we see that reference to 351 and 368. So these are sort of the two fundamental corporate reorganizational code sections in the Internal Revenue Code. 351 is going to say that we don't regard a transaction if it meets certain qualifications, meaning ownership, stock, things like that. 368 deals with tax-free reorganizations where we're merging companies or we're doing some sort of activity that's not quite exactly just a contribution in 351, but actually more of a reorganization under 368. So the beauty of this is, and it's a tricky question, and Mike got right to it, what is the advantage to doing this for a tax reason? So a lot of people are going to say tax-free reorg. That sounds great. But in reality, it's not really a tax-free reorg. It's a tax-deferred reorg. So you're really only getting the benefit of the time value of money. That being said, with large corporations, that benefit is very large. So,
yeah, and to think of the timing and the description of the transaction in 1113, they are laying out explicitly when we think this is going to happen. And so, to repeat a tax question that is a basic tax question for somebody who I can't remember if I passed federal tax or not, what is the difference between that tax savings and tax deferred? There seems to be, to your point, a lot of effort to make this transaction be in a different year. I don't know if they're trying to put it in the year before, or the year after, or how that works. But like, if you're making the taxation decision are you trying to give yourself the flexibility to pick which year this thing goes in, or
Mm.
do these timing statements make it so we're saying through the contract we're going to peg this transaction in this year for the purposes of taxes?
I mean, that's a great question. There's a lot there. Um, so firstly and foremost, I would say that when we say that we have gone ahead and deferred the taxes again, what I want to reiterate is think of a very large corporation that's going to save $100 million for 5 years. That $100 million is going to be reinvested and create more gains, more assets. So, um, it's a plus and a minus on that aspect. And then as far as timing goes, it also is kind of a complicated issue because we want if the transaction is going to be a taxable transaction eventually after the deferral is over, we're going to want to lay out which dates we want to see the income fall into, which dates we want the transaction to close in. And these are very different things. So we might have a transaction close in 2022, but due to certain tax reorganizations or other tax rules that come into play, we might not actually recognize that income until 2025
Hmm.
on, let's say, a sale of an asset that was related to that has that what we call built-in gain.
Got it.
Um, so timing is critical, and 368 and 351 are going to have timing requirements. So you're going to see language like immediately following, immediately before, things like that.
Well, again,
So
they're trying to repeat on a theme. I think in 1.8, this section titled "Tax Consequences," and it points to something that is not unique but interesting about this conversation, which is that we're not just dealing with U.S. federal income tax. It does say for federal income tax purposes, to the extent not in contract with Israeli companies law, etc. Again, repeats this point about 351 and 368. What do you think about Section 1.8 and particularly the reference to Israeli law and how these, without digging into international tax, which is a whole area, sort of how, when you're drafting a contract, you need to be mindful of the fact that you've got international tax implications?
certainly. So, yes, like you said, international tax is quite complicated. It's something I've focused on, but I'm not going to dig into it here because I don't think it's relevant to this conversation, really. Um, but you're absolutely right, Mike. When you have a foreign country and you're dealing with the U.S., you have two jurisdictions with two different taxing systems, two different legal systems, two different governments. Um, there's a there's an aspect of, you could call it comparative law, possibly, or something along those lines, where it's going to take somebody who kind of has an understanding of accounting, finance, and economics that can take the tax rules in the United States, look at the tax rules in another country, and kind of somehow get to that same meeting. Um, and if we can get the two tax systems to fit where we're not double taxing the income in both jurisdictions, that's the perfect ideal situation for an international tax planner. Other than, of course, putting everything in the Cayman Islands, which is not advised. Um, so yeah, I mean, I think you make a really good point about that, Mike. We have to be really careful when we're dealing with foreign countries. Again, there's a lot in the international tax realm, but I would just say this is an example of many different laws. We have companies laws, corporate laws in the U.S. tax laws, Israeli tax laws. We have tax treaties. So there's a lot that goes in here. So it's not just a simple section. You really got to work through all these.
Yeah, and it's tough because it feels almost prohibitive, right? Like if you're one of these big companies and you can go hire one of the big four accounting firms who you work for a while and get all of this stuff figured out. At the same time, we've got all of these very international transactions now. I mean, we're very connected. And so you have even small transactions, significantly smaller than this, who are, trying to work together. And it's just, crazy to think of the cost structure of figuring this stuff out that's associated with what might not be that big of a transaction in some of
Yeah,
these
yeah,
mergers.
that comes up. Yeah, I mean, one other thing to think about, just anecdotally, is if we're doing a merger like this cross borders, the U.S. company may want to send some of its employees to Israel for a year or two, maybe a month or two, maybe forever. Um, that's when we get into our expatriate talk and we get into all that stuff. So definitely not going to touch that today.
Hmm.
But I mean, it's just an example of a couple paragraphs in this contract that seem pretty,
Hmm.
benign. actually have quite a bit in them.
Yeah. Again, an interesting thing that we're trying to do with the contract, something that reflects what we're trying to do in compliance, right? So, speaking of 3.8, this is a really long section. The 3.8 really is going multiple pages, covering all kinds of things, and some of them are, to your point, fairly benign. They're trying to state they're trying to lay out what the state of the two companies are beforehand and afterwards. And in our conversation before, I referred to this as a prenup, right? This agreement where you're laying out, here are my obligations, here are your obligations. I'm making representations that I'm not being sued right now, that I'm not messing around on my taxes. What do you think of Section 3.8 and tax matters for that purpose?
So this is critical when you're dealing, especially, I didn't say this last time, it occurred to me just now, but especially when you're dealing with a unrelated party transaction, this becomes very critical. In a related party transaction, it's hopefully not as critical because your departments are speaking to each other, and it would be pretty easy to figure out who's responsible for what tax filing obligations in which country. In a unrelated transaction, um, that becomes much more tricky because the seller wants to probably get rid of all of the liability, all of the responsibility for filing any taxes anywhere in the world, whereas the buyer is going to want them to stick around for a little while and wait. So we'll often see these escrow accounts created where the buyer and the seller agree that they're just going to put money into an account. No one can touch it for 6 months, a year, something like that. But these tax matter issues really are who's going to file what returns. And when you have different companies with different interests and they're working toward a merger, and I've seen this happen the day the merger happens, those two people never talk again. They might spend a month talking every day for 5 hours. They'll never talk again. So when it comes to figuring out who's responsible for filling out the tax forms, this section is critical. It's important.
Speaking of nerdy things that I don't know what you're talking about, you introduced me to a term when we spoke before, which is the boot. Pirates booty, obviously. We're going to talk about Section 1.9, and it's titled Assumption of Company Obligations. Tell us about Section 1.9, what it's trying to do, and specifically what this boot is that you were referring to.
Sure. So this is going to get a little tax techy, but I think it's worth it here. I think it's definitely called for in this case. So the assumption so basically when we have 351, 368, these different code sections that are giving us favorable tax treatment, there are often going to be these rules that say you can only exchange shares. You can only exchange stock in a company for stock in a company. Otherwise, it might not be tax free, because the whole point is if you're passing cash along with it, then you're kind of making a payment, or you could be making a payment in a hidden manner. So to get around that, what the tax code says is we're not going to disqualify your entire tax-free status or tax-deferred status, but we are going to look at the consideration that you have paid for this company. And in doing so, if there's anything that's not accounted for in the shares, that is essentially going to be treated as what we call boot. Typically, you think of it as $100 of shares in company A plus $10 of cash in company A. That $10 of cash is your boot. That does not qualify for the tax-free treatment. The tax-free treatment sticks only with the equity portion. So putting yet another twist on that, this is a really interesting section, because it's saying the assumption of contingencies, assumption of liabilities. What they're really getting at, of course, here is that they want to make it clear. Let me just pull the language itself. They want to make it clear, that they have an obligation, essentially a liability or a debt of some kind. It could even be a tax debt. But that obligation is out there. And if they transfer that obligation in the sale, so if the seller wants to essentially unload that position with me and give me as the buyer the potential for this, then essentially I'm going to have to look at everything they've given me and anything outside of shares, which is cash, and then assumption of liabilities is another big one. So that's why I really wanted to point this section out. Sorry, I was kind of long-winded there, but basically boot is boot is consideration paid that is not in equity, and it doesn't have to necessarily be a positive rate. It can be a liability. So you have to look into these things.
Got it. And I'm thinking sort of big picture as we close, as we often do. I can't be the only lawyer who was like, man, tax law, right? We all, there's the cliche, we didn't go to law school to do math. And I think for a lot of us, that's true. But these people are doing something purposeful, which is using the contract to check some boxes on some tax compliance issues. It sounds like from what you said before, there's a risk to that the IRS might feel like that's literally all you're trying to do with this document and with this transaction. But also, I assume there's an opportunity here. There's a way for businesses to use contract drafting to make sure that they satisfy the client and to get out of adjust some of those taxes to their advantage. What do you think about that? What do you think about the big picture of using contracts for these tax purposes?
I think it's probably the most critical, the easiest way to tell a court or to tell a adversary or a target or a buyer of what the situation really is going to be. If you're uncertain about tax, which almost everybody is, especially in today's economy, as it's changing around the world at rates we've never seen. If you're not sure about tax, it's good to have those sort of guarantees put in place. So you have those checklists put in place. I don't think there's anything wrong with it. And I'm saying that mostly from experience, just because I've seen so many of these contracts go through IRS audit, other accounting firm audit, law firm scrutiny, etc. And they always seem to be okay. So yeah, I mean, I would stick with that. And one other anecdote, and I didn't want to point this out, but I will say it. There is some ruling, some sense, some authority that is telling us that the avoidance of taxation actually itself could be a business purpose in some cases. So I'll leave it there and just say that tax is extremely complicated, and it doesn't need to be, but it is. And I think that's a perfect example of it, that, we have to have a non-tax business purpose. Okay, the non-tax business purpose is to save taxes. Well, what is it?
Yeah, it's interesting because obviously, politicians use the tax code to do all kinds of social engineering, really. And so they're favoring an activity, and the activity that the code is trying to favor is economic movement, the movement of money. And so these kinds of deals are actually within their purpose. But, if people start playing too many reindeer games, it makes sense that it starts to undermine the initial social engineering purpose.
Yeah, no, I think you said it really well. I think that's a very good way to put it.
Well, I'll tell you what, Tyler, I never want to talk to you again about taxes. I want this to be the last time that we talk about it. But other people who are watching this might love talking to you about the tax implications of these documents. If people want to chat with you, what's the best way to reach out, Tyler?
Sure. So please, you can reach out to me by phone if you like, 949-466-7429. Alternatively, and probably better, would be by my personal email, which is stonetyler03@yahoo.com. Look forward to any questions you have. Feel free to reach out to me.
Perfect. We'll have that information, a link to this contract over at the blog post on lawinsider.com/resources. And if you want to be a guest on the Contract Teardown Show to beat up contracts like this, just email us. We are at community@lawinsider.com. We will see you all next time. Tyler, thank you again. We'll see you guys next time.
Okay.
Thanks so much for tuning in to this episode of the Contract Teardown Show from Law Insider. If you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. That helps others find the show. We really appreciate it. Thanks again for listening, and we'll catch you in the next episode.